So, are you a home buyer in the wonderful state of New Jersey and you're like, I really want to buy a house, but rates are kind of high? If you stick around, we're going to show you how to lower your rate, save some money, and better yet, make the seller pay for it. Stay tuned, we're getting after it right after this. If this is your first time to the Living in New Jersey channel, welcome. If you already belong to our beloved YouTube channel community, awesome sauce. Either way, feel free to click on the subscribe button, tap the bell for notifications so you'll be alerted to the amazing videos such as this one. My name is Matthew Williamson. I'm a real estate professional. Tongue twister. I'm a real estate professional here in the wonderful state of New Jersey. I help people buy and sell houses. And on the daily, we get communication from you. And what we really love to see are comments down below. So make sure that you leave them. And we want to take a home buyer such as yourself and turn them into what you see around me. And what you see are awesome reviews, happy faces. Those are people that we helped get to the closing table that I lovingly refer to as the promised land. Now, if you watch my videos, you know who my partner in crime is here. Ride or die right here. Some people call him Dr. Money. Some people call him Dr. Love. We'll talk about that some other time. But today, he's going to school us on how to lower your interest rate. And as the buyer, you don't even have to pay for it. Go ahead and take care of it for us, boss.
How's it going, everybody? My name is Brian DeVito. I'm Senior Vice President of Mortgage Lending with Guaranteed Rate. And today we are going to talk about a rate buy-down program.
Boom, rate buy down. Not to be confused real quick with, I don't want to go into segue, paying points.
No.
Because just in case the person's watching going, I know it's paying points.
No, totally different.
Totally different. So we're going to eat that stuff for later. And we're going to talk about rate buy down. So go ahead and school us on it. And in regards to the buyer not having to pay and just all of that jazz, how's this work? And do it.
Sure. So there's several different types of a buy down. There's a 3-2-1, a 2-1, a 1.5%, a 1-1-1. But for today, we're just going to focus on the 1-1-1 because the math's real easy and it's going to be easy for us to explain it to you guys. So what this means is, let's just say if today's interest rate is 7%. I'm not saying rates are at 7%. I'm just using that as an example. With a 1-1-1 buy down, the interest rate on the buyer's mortgage would be 1% less for the first 3 years than the start rate. So again, we said, say rates are at 7% today, with a 1-1-1 buy down, the buyer would make a mortgage payment based upon a 6% rate for the first 3 years. After those 3 years, then it would kick up to 7%. As Matt said, buyer's not allowed to pay for it. The seller has to pay for this. So if, let's just say that the monthly payment difference from a 7% rate to a 6% rate on a $500,000 mortgage, let's say that that's $300 a month. So $300 a month times 12 months is $3,600 times 3 years is $10,800. That is the cost based upon these, fictitious numbers that a seller would need to pay so that the buyer would get a 1% less payment for the first 3 years.
That's a great word, by the way, fictitious. Thanks for throwing that out.
Examples.
Bonus word for the day. So in this example, we're using 7%. But again, if the regular market rates today were 5%, you can still use it. And in the 1-1-1, it would be 4%.
Exactly.
So the seller is paying for the buyer to drive that rate down for the first 3 years.
Correct.
Now, a question comes up, and we talked about this a moment ago, is that basically I will tell buyers this, and they basically say to me, what seller is going to, they use a colorful word. I won't really say it on video, but I'll put it up. And they're basically like, what seller is going to, and insert that word here, pay for this program? If I may, if a house is $500,000 and you, the buyer, are going to write an offer for $490,000, right? $10,000 discount. So $490,000. Well, the point is, a seller, if they're going to agree to that, why wouldn't they agree to do this? Because to the seller, it's 10 grand is 10 grand.
10,800.
10,800. And he'll get to that in a second. But basically, the program costs money. As we said a moment ago, you, the buyer, you can't pay for it. It's not allowed. The seller has to. And as Brian said, this program we're talking about in this video is the 1-1-1. There's money that the seller has to pay to make that program work. And with the math he just said, you heard him say it, $10,800. So again, if you're going to write an offer for $490,000, well, rather than do that, just write an offer for $500,000 and say, hey, seller, I'd rather have you pay for the program. So again, to all the naysayers out there, to all the buyers who are basically like, who's gonna pay for it? Well, the seller is. And again, it comes down to where your mindset is anyways. If you're gonna write an offer for 10 or 15 grand off of asking price, but do this. And again, there's all kinds of different programs out there. I mean, I love this program.
Yeah, it's great. And basically the way it works is that $10,800, let's say that we get the seller to pay that. That money basically it's a subsidy. And that money goes into a piggy bank.
Oh,
and as the buyer makes their payments, let's just say that the payment at 7% is $3,000. We said that for the first 3 years, it was going to be $300 less. So the way it works is if I'm the buyer, I send my first mortgage payment in of $2,700. The lender is going to stick their hand in the piggy bank, pull out $300, add it to the $2,700. The buyer is essentially making the payment based upon the 7% rate, but we're just taking $300 out of that piggy bank to make that payment whole. The other beautiful thing, let's just say, for instance, that the buyer, they get the seller to pay for the buy down. They only have the loan for a year. Let's say rates drop to 4%, which I hope happens, but you never know. Amen. So after a year, rates drop. The buyer wants to refinance the mortgage. They've only made 12 payments, so we've only used essentially $3,600. We said $300 less times 12 months, $3,600 minus or subtract that from the $10,800. We got $7,200 left over. If the buyer were to go and refinance, it's not like the lender keeps that $7,200. That money would then get applied towards their principal balance so that when they're refinancing, they can actually use whatever money was left over. So it's a great thing.
That was also well said. And just in case you're wondering, we've talked about making this video for a while, and we don't want you to be confused. There's kind of a lot of math here. We know that. But the subsidy, just so you're like, okay, what is this? Where is the subsidy? Where's the money coming from again? As Brian said, not to be too repetitive, because you did explain it beautifully. As he said, 7%. In this program, you are paying 6%. Well, there is a difference of money there. It doesn't magically just happen, right? That's why in this program, for this particular instance, the fee, as it were, to the seller is $10,800.
Exactly.
Because that money, that difference is between the 7% and the 6% on that loan.
Right. Over the course of those 36 payments.
Right, because it's a 111. So if you're like, well, I don't get the $10,800, that's it. So at 7%, it's this. At 6%, it's $300 less. So the bank is saying, all right, $300 less over a 3-year period is $10,800 in this scenario.
Exactly.
That's the subsidy. That's where if it's like, well, I'm gonna write an offer on a $500,000 house, I'm just gonna say $490. Well, just say I'll pay you $500 and seller pay $10,000 in this program. Now, I will say this. These are sort of generic numbers. I'm having a tongue-twisting day today, I ain't gonna lie to you. Tongue-twisting, and honestly, I had coffee, so I have no excuse. So my point is, getting back to it, and not my, my coffee and all my tongue-twisting moments. Maybe I'm having a senior moment. Can you say that?
Yeah.
I'm not quite a senior, but I will be soon, in many, many years. But the point is, there are different programs. So 111, there's 2-1, there's a 3-2-1.
Yep.
And every one of these programs changes based on the actual property you pick.
Right.
Now, Brian chose the 111, and he gave you an example of 7% to 6% and what it would be. But bottom line is, if you're like, hey, I like the idea, bottom line, of lowering my rate and the seller paying for it, awesome. Because that's what it's about. At the end of the day, do you want to lower your rate and have a seller pay for it? And you've talked about it before, and kudos to you, because you kind of gave good examples where it's like, okay, when would I use this? I mean, obviously you can use it at any time, but having talked with prospective buyers, a great example is it's like, okay, I love this house, but that payment right now would kill me. I know I'm going to be promoted. I know 100%. They're giving me the promotion in writing, the contract signed. I get promoted in 6 months. That job is coming. That other bigger pay is going to be there. But right now, oh my God, this would kill me. But I don't want to lose the house. And it's like, oh, that's a great example.
Yeah.
You do the rate buy down, you get that lower payment, and then obviously you have it for 3 years in that scenario. But it's scenarios like that where you'd be a right fit, a right candidate for that program. Yeah. I just think it's a great program.
And most people that are salary W-2 employees, a lot of the times maybe they do get like a 3 or 4% raise each year. So this is something where, like Matt said, maybe the payment's a little tough right now, maybe we look to incorporate a buy down into the offer, reduce the payment for the first couple of years as their pay goes up. And the other thing too, if rates do drop, which we expect them to do, you could always refinance the mortgage. So it's a great thing to, to incorporate into an offer now to battle these higher rates.
And as you said a moment ago, and we're just kind of Q&A-ing it here, although he mentioned it just at the start of the video kind of, they don't lose that money.
No.
So as you said, oh, okay, I'm going to do this 111 or the 21 or 321, all these different cool programs, and they are cool, so you should definitely reach out to Brian or myself. But that money's not lost. So in that example, you got $10,800. Well, if a year and a half in, you got basically half of that money sitting in a piggy bank, and you refinance it because the rates go down so low, well, you guys take that leftover money and throw it to principal.
Exactly.
So you don't.
So you're borrowing less money. And with these numbers, they're all going to vary based upon the loan amount, the the interest rate. So again, I just use fictitious numbers as an example. If you want to run specific numbers for a specific property, our contact information is going to be below. Feel free to reach out to me. I'd be more than happy to run them for you.
Yeah, and that's easy for you to do.
It
They
is.
can say,
I got an Excel
here's
calculator.
this.
I just plop it in, boom, hit enter, and there you go.
And you can show them all the other programs too. The 111, the 321, just so awesome. I just want to say it because it is kind of cool. I'm not going to get into it because we're going to get right in this video because it's already too long, right? It's too long. But the 321, that's a monster.
It is.
And we don't get
it's
into
also the most expensive though, because that first year you're getting a 3% less rate. Second year it goes to 2%, so it's definitely the most costly. And one thing too, when I say that the seller's going to pay for it, they're paying it through a seller concession.
Correct.
We did another video on seller concessions, so the link will be below if you want to read up on that. But that's actually how it's incorporated into the offer.
Yeah, it's good to point that out. Say, hey, how is the seller doing it? It manifests itself through a seller concession, as Brian said. So, well put. Anything else? We kind of covered it here, right?
I think we did. Again, it's a great program to help, reduce the monthly payments for those first couple of years. So if you have questions, reach out.
Excellent. Our contact information, as Dr. Money said, our contact information will be down below. Feel free to reach out to us. We appreciate you investing your time. We appreciate you taking the time to watch the video. Feel free to click on the subscribe button, tap the bell for notifications so you'll be alerted to amazing videos like this. And once again, we'll see you around the block. Take care.
Take care, everyone.
Bye-bye.
Bye-bye.